Hi everyone, welcome to another episode of the Property Finance Podcast. And today we're going back to an AI interview. So recently did an AI interview where I was asked questions about bridging finance and development finance. So I thought, you know what, these have done quite well. They're well received by everyone who's had to listen to them. So I've gone back to ChatGPT and I have said, well, this is the prompt that I've used. So I've said, act as a property developer. I am your development finance broker. What questions are you asking me to get an understanding of the process and the products? And it was really interesting to see what came back. So I thought, let's do a couple of episodes just basically running through what AI believes is the most asked questions when it comes to talking about development finance and understanding the process of development finance. So the first question that it asks are, what are the key criteria that lenders are looking for in property developers when assessing applications? So I think there's a couple of key bits to touch on here. So the first one that they're looking for is obviously experience. So they want to understand, as a developer, do you have experience as a property developer previously? If you don't have experience, have you got a good team around you? Is there a good contractor on board? Have you got maybe a decent net worth instead to kind of make up for it? So have you got a few buy-to-lets behind you? So that's kind of the first one they're looking at, is that experience point. Then when it comes out of maybe looking at yourself, maybe looking at the project instead, is the project profitable? That's obviously the first thing they're going to be looking for, because they want to understand, is it actually going to make any money? The exit strategy out of that deal as well. So are you selling? Are you refinancing, for example? They want to understand, if you're selling, is there maybe a good demand in the area? If you're refinancing, is there a decent lender who can take over, put it onto a buy-to-let mortgage, for example? And they want to understand sort of the rental market around there as well. So in terms of key criteria, I guess exit and experience are probably the two main ones that they're looking for. Then the next question that AI has come up with is, are there any specific documentation requirements I should prepare upfront, e.g. project plans, planning permissions, or valuations? So there's kind of two things that they're going to look for, which is your CV and then also a build cost breakdown as well. So the CV is kind of going to be a breakdown of your experience, the contractor's experience, for example. And then in terms of the build cost breakdown, they're not going to want to see War and Peace. They're not going to want to see a price per brick, for example, but they're going to want to see an average build cost across the site. So there's not a huge amount of documentation that you need to prepare up front, but there's a bit that you're probably going to need to do in order to get it through. And then the last question that AI asked on kind of this eligibility and requirement section is, how does the application process typically work and how long does it take to get from application to funding? I think this is a really good question because this is brought up pretty much on every transaction that we do. So every single client that we deal with always wants to know, how long is it going to take, what's it going to cost, and what timescales do I need to prepare for? So in terms of the application process, you would come to us with the initial inquiry. We then package it up. We then send it out to the lenders. Normally takes a couple of days for lenders to come back. There's obviously a lot of questions that we have to field. They obviously come back and ask us a load of questions. We then have to ask you the questions. So that normally typically takes 2 or 3 days to kind of go from initial inquiry through to an agreement in principle. And then from that point, you're then talking about getting valuations in place and talking about getting quantity surveyors in place, then moving into legal. So I would say in terms of timings, you're probably talking between 8 and 12 weeks to get everything done, because what you would normally do is you would go initial inquiry, then through to agreement in principle, then through to valuation, then through to quantity surveyor, then through to legals. And in between each of those stages, obviously there are questions that have to be answered. There are documentation bits that need to be completed. So normally that process takes between 8 and 12 weeks is on average how we found it. Then moving into kind of section 2 of AI. So the first question under kind of stages of funding is, AI has asked, how is funding typically structured, e.g. stage payments, milestones, or upfront? So development finance typically sits in 2 camps here. So what will happen normally is that development finance will give you a stage 1 drawdown, so a day 1 drawdown, which typically goes towards the purchase or refinance if you already own the site. And that is typically around 60 to 70% of what the land is worth or what the property is worth. And then what happens after that is it then goes into stage drawdowns. So what will happen is you will have a certain set of stages that the QS or asset manager will come up with and that you will agree to deliver by. And as you hit each stage, that could be monthly, fortnightly, it could be quarterly, however you decide to draw down the funds. But as you hit each stage, you then request a drawdown from the QS, go to the QS and say, right, I've spent this money, I've done these works, I'm now looking to draw these monies down. So typically it tends to be a day 1 drawdown and then a stage payment. Some lenders will work on milestones. We have one in particular that works on milestones, which rather than a QS kind of going out and agreeing a set sort of build plan, if you like. They will set out a list of milestones, and as you hit each milestone, there is a certain percentage of the build cost that's assigned to each of those milestones, and then you will draw down based on those milestones. So the second question that AI has come up with under this kind of section of stages of funding is, what are the usual requirements for drawdowns at each stage? So it varies lender to lender, depends on what you're doing. If we take kind of an average deal, what will normally happen is you'll either have an asset manager or you'll have a quantity surveyor. So the asset manager normally will go out and will maybe take some photos, will go through kind of, right, okay, here are the invoices, here's what you've done. Be very, very light touch. There won't be a huge amount of stuff required from you other than a couple of invoices. When it comes to the quantity surveyor side of things, it's far more in depth. They're going to want to understand every single thing that's been paid out. They're going to want to walk around site. They're going to want to look at everything. They're going to want to actually individually check off each thing. So if you've claimed for First Fix Electrics, for example, they're going to go into the property, they're going to look around and ensure that First Fix Electrics and everything that's included within that have all been done, achieved, invoices for each one, and be able to tick those off. So it's far more in depth. So you need to probably prepare a full list of the works that have been done, itemizing each one individually. You need to have invoices linked to each of those individual things that you're claiming for, and the QS needs to be able to come out and look at all of those as well. So it can't really be done by photos as such. It needs to be a proper site visit where the QS comes around and looks at everything. And then the last question under stages of funding is, can you explain how the loan to cost and loan to value ratios affect the funding process? So in terms of affecting the process, they don't as such. However, they do have an effect on how much you can borrow. And what we tend to find is that clients will hit the loan to cost ratio before they hit the loan to value ratio. The reason being is because loan to cost tends to be that lenders will lend up to, say, 90% of the total cost. So that's your build plus your purchase. What we tend to find is that lenders hit that 90% before they then hit the, let's say, 65% loan to GDV. So with loan to cost, it's a ratio that not many people sort of come up with. They normally think loan to value, loan to GDV. They don't tend to think about loan to cost. And I think it's really important because that loan to cost can have a massive impact, because if you're potentially on a really profitable scheme, you might find that actually your funding is limited by that loan to cost, because obviously you're going to hit the loan to cost before you hit the loan to values and loan to GDVs. So whilst it doesn't affect the process as such, I think it does have a massive impact on the total amount that you can borrow. The third section is all about repayment. So the first question that's come up is, what are the typical repayment structures for development finance? And I would say there are three. So the first one is just straightforward sales. So if you are selling, obviously those sales, then as they come in, pay off the development finance. Really simple, really easy. The second one is refinancing onto a commercial mortgage or a buy-to-let. Again, really simple. Property gets to completion, you refinance that property onto a mortgage, that mortgage then pays off the development finance. Again, super simple. The last one that we've seen a lot of people take at the moment is development exit finance, which essentially is kind of a sales bridge, is probably the best way of describing it. And what happens is you will get to practical completion, or you'll get to wind and watertight, or whatever stage you might be at, and you will then refinance onto this sales bridge. And what will happen is then that will pay off the development finance and will then essentially take the position of that development finance to then allow you more time to sell the properties. I've spoken about development exit loads on loads of recent podcast episodes. So obviously I would definitely have a listen to those to get a sort of further in-depth understanding of development exit. Then the next question under this repayment section is, how are interest payments handled, e.g. rolled up interest versus retained interest versus monthly payments, i.e. serviced. So when it comes to development finance, there is not a single lender that I'm aware of that does serviced interest. The reason being is because, as a rule of thumb, development finance tends to be on large chunks of money. So servicing it just isn't going to happen. So you tend to be, I mean, we do development loans up to kind of 10, 20 million. If you imagine if people were having to service that on a monthly basis, it just wouldn't happen. So I'm not aware of any lender that does serviced interest. Then talking about rolled versus retained, recently spoke about it on a podcast with Josh over at Octane. Obviously, the differences between rolled and retained. So obviously go and have a listen to that for kind of a bit more of an in-depth run through the numbers. But as a rule of thumb, most development finance lenders will retain interest. So essentially they take that interest off day one. Some will roll it, which when you actually work out the numbers side by side, rolled interest is far more effective because actually what you find is you end up with pretty much the same day one monies, but in the rolled scenario, you're paying interest on what you actually truly draw down, as opposed to retained, where you're paying interest on not only what you've drawn down, but actually the interest on what you've drawn down as well. So it does tend to hit quite hard, retained interest. Then the next question is, what happens if the project experiences delays or exceeds the planned timelines? So there's a few options here when it comes to repayment if you have delays. So if you have a delay, a small delay, I would say most lenders will allow some form of extension. If you're going to have quite a significant delay, I would say you probably need to think about refinancing. So that could either be refinancing to a development exit product, for example, could be refinancing to another development lender, depending on what stage you're at. But there's a couple of options there. So I would say if you have any kind of delays, normally you would look at an extension or a refinance. One of the big things that I would say on this, so talking about delays, and again, I've spoken about this quite a bit, is communication. So we have seen on a number of deals recently where clients have not buried their head in the sand, but have deemed that they don't need to communicate as much as they should, have experienced massive problems with lenders. Lenders have been less kind of engaged with them and less of a desire from them to want to help because that communication just hasn't been there. So I think if you can communicate with the lender, communicate with the broker, communicate with everyone in the team, if there's going to be a delay, I think you will find that actually there'll be far more assistance out there than you maybe thought. And I think lenders will be far happier to kind of help where they can. And potentially it removes the need to refinance as well. Because if you can get an extension rather than refinancing, most of the time it's going to be a bit cheaper. The next section, it's asked about exit strategies. So we've kind of spoken on this a little bit already, but these two questions I think just deep dive into it a little bit more. So the first one is, what exit strategies do lenders prefer, e.g. sale of property, refinancing? So I would say most development lenders prefer, well, it kind of depends, but I would say most prefer refinancing because to a degree there is a certainty there. You know, from a development lender's perspective, you know, as soon as you hit this point, you're refinancing, you're going to be paid out. Obviously, there are risks around the refinancing. The refinancing may not go through, but you know that with a certain degree of certainty that you're going to be refinanced out of that deal pretty quickly. Sales bring with it an inherent risk. So they bring that risk of, are the properties going to sell? Are they going to sell for what you expected them to sell for? Are they going to sell as quickly as you expected them to sell? It brings with it that degree of uncertainty. So I would say most lenders probably prefer kind of that refinance model as opposed to sales because it does bring that little bit more certainty. However, that being said, if you have a sale agreed and it's a guaranteed sale, obviously, again, that takes all uncertainty out of it and is far more preferable for a lender. And then the last question that it's asked in this section, so this section of kind of going through understanding the process, the last question under exit strategies is, how critical is a solid exit strategy in securing finance? I would say is the one and only thing that matters. Everything else can kind of be ignored to a certain degree. The exit strategy is key. If you don't have a solid exit strategy, no lender is going to lend. They can get over most hurdles. So, for example, experience, just bring in an experienced contractor, you get over that hurdle fairly easily. But if you don't have a solid exit strategy, no lender is going to want to lend to you. So I would say in terms of how critical it is, without a shadow of a doubt, it is the most critical thing that you get in place. So whether that be lining up a refinance, whether that be ensuring that your sales are going to be strong in that area, so only developing in an area where there's a strong sales demand, it is without a shadow of a doubt the most critical thing. So I think getting that exit strategy in place, without a shadow of a doubt, first thing you should do. And that pretty much brings section 1 to a close. We'll do another episode where we talk about kind of section 2, which is understanding finance products. But hopefully you found that useful. Hopefully you're enjoying these little AI interviews. I know I've found them quite in-depth and entertaining, but thanks for listening. Catch you on the next one.